I want to welcome everyone. Thank you very much for everyone being here. I want to remind you that we've gone on a journey and we are part of this journey, but Garth and Anthony have very kindly agreed to come and join us this evening to do a VIP session and to answer the questions. So what we're going to do tonight is there's not going to be slides in terms of it, but the whole idea was to run through some of the macro trends, the economics, the investment, and the wealth review, and then sort of look ahead to kind of 2026. So it's, as always, I really appreciate you guys being here. Garth, I know that you had some medical stuff today, so I really appreciate you both being here. Thank you very much in terms of that process. And yeah, the whole idea tonight is that to do this and to try and have a conversation. Where you guys gone? I need to find your... Where are you going now? Where's your camera's gone? Okay, I was gonna... Oh, there you are. Yeah, so I need to spotlight, and Anthony, where have you gone? I need to find you. There we are, spotlight you. Yeah, got you. There we are, and then I need to spotlight myself, and then we should be good to go. Okay, good, we got everyone. Guys, I'm gonna mute everyone. God and Anthony, I'm gonna mute everyone. You're gonna have to just unmute yourself, just so we don't have background noise and stuff. Guys, everyone's muted now, and then if you guys can just unmute yourself again, I'd appreciate that. Awesome. So it's that time of the year where we're fast approaching the end of the year and everyone is sort of thinking about the year. What should we know about the year? And, you know, I always really appreciate when the three of us can get together and ask questions. You've got so much knowledge to share, and it's always so valuable for people. And what we found, both Garth, Anthony, and myself, is that it's not about coming with PowerPoints and presentations, but actually about having a conversation. So that's really the intention. What I would suggest is I've got a number of questions here that to kind of take it through, and I've discussed it a little bit in terms of preparation. And if people have questions, I don't know if Garth and Anthony, you guys agree, but why don't we let me run through a couple of the questions, and then towards the end we can kind of do a sort of an open Q&A in terms of what people are thinking. I don't know, you guys happy with that? Otherwise we might go left and right, at least we can have a bit of structure then.
Yeah, I don't think we're controlling it, so yeah, I'll buy into that process. I think it'll be great.
Awesome.
Very happy with that. One caveat, I might have a slide or two, as always.
Oh yeah. No, slides all good, dude. Slides all good. I think the point, I also have some slides that makes you feel better, Anthony. But I think the point being is that just not death by PowerPoint from my side is what I was trying to get at, you know, so in terms of conversation.
So I should cut down my 57 slide presentation that I've got planned until 12 o'clock tonight.
God, I know you well, Bugger. There's no PowerPoints. I've done this with you for 10 plus years.
Well, then I'm going to apologize in advance because after having an MRI today and discovering that I am highly allergic to the contrast dye that they put into your system. Yeah, so it was the equivalent of being, stung by a bee for me. So they put me on antihistamine and all sorts of things. So if I seem a little out of it, I'm less energetic than usual. I'm on a bit of a low here.
Fair enough. Well, thank you for being here. I really appreciate it. Yeah, it's a little bit of and God made me promise going forward that we don't do stuff at 7 o'clock at night. So I'll take that on board for the future. So all good. All good. Anyway, guys, let's rock and roll. So the first question I had here was, what are the three biggest macro shifts shaping sort of 2025 into 2026 that everyday investors are not paying attention to but should? And again, I'm just going to put open questions, and you guys can hit me with whoever you think should answer.
I think we'll both answer, but I'll let Ant start with leading it. And if he covers what I was going to cover, then I'll just stay quiet. Go for that.
Yeah, I think maybe important to understand the environment that we're in, the environment that we've come from in terms of markets. Just for those of you that are new here, I typically focus on listed markets. That's my area of expertise, and then Garth typically comes in from a private equity point of view, just so you kind of get the context of how we kind of dovetail together. So in terms of markets, what have we seen this year? We've seen an incredibly strong performance out of tech-related investments. That has been a theme now, probably for the better part of the last 18 to 24 months. I think that's something that everyone here is comfortable with, is familiar with. In particular, that has been driven by artificial intelligence. From a macro level, we have seen a number of things play out over the last couple of months. I think the most important one of those is tariffs, in particular, US imposing tariffs on the rest of the world. We saw President Trump come into his term earlier this year, and we saw him announce a massive round of tariffs in the beginning of April. That sent a bit of a shiver down the spine of markets. We saw the markets react to that. They sold off quite aggressively. But fortunately, within a couple of weeks, markets had recovered and they were back up into all-time high territory. Throw into the mix declining interest rates. We saw the US start to cut interest rates towards the end of 2024, and then we saw them pause on those interest rates for the better part of 2025, and that has restarted again with the first 25 basis point interest rate cut last year. So that's the environment that we're in now. There is quite a bit of commentary around overvaluation, again, particularly directed at the technology and artificial intelligence space that has been doing the rounds again. It tends to flare up and go quiet, but that is very front and center at the moment. So what does that mean for opportunity? What does that mean for macro shifts forward looking? I think it's an interesting landscape. I think we've seen a lot of momentum in the market, and I think that momentum could potentially continue. Don't underestimate momentum. Don't underestimate investors piling into companies that have done exceptionally well. So could we see that continue into the new year? Potentially. Could we also see some volatility as a result of those overvaluations and perhaps a small correction in the markets? Yes, I think that is also very likely. What are we focusing on now? I think it's important to kind of have a wide vision at the moment. I think it's important not to be narrow-minded and trapped in certain styles and sectors. I think at some point we've seen this, as I said, we've seen this kind of meteoric rise in technology companies, and the rest of the companies have really been left behind. By way of an example, think of the S&P 500, which is the 500 biggest shares in the US. A buzzword over the last couple of months has been the Magnificent Seven. That is seven technology companies within the S&P 500. But ultimately,
just to be clear, Anthony, that's all the ones that people already know: the Amazons, the Meta, Facebook, the Googles, whatever.
That's it. Yeah, Google, Microsoft, Apple, Nvidia, Tesla. Those would be your Magnificent Seven, and really they have been the key drivers of US performance over the last 18 to 24 months. They have been doing all the heavy lifting, and they've been dragging that index up with it. Now, how these indexes work is that they're based on market capitalization, right? So as these companies get bigger, as more and more people invest in them, their market cap grows and the percentage that they occupy of these indexes increases, right? Couple of years ago, you probably had Magnificent Seven at around 20% of the index. That's pushed all the way up to, I'm not sure the exact number, but 25s, 30s, even potentially into the 30%, which means that you've got a lot of concentration, you've got a lot of risk sitting in those seven companies. So I think, again, going back to what I was saying earlier about looking forward, I think one of the potential opportunities could be making sure that you are re-diversifying out of those holdings that have done well. When I say re-diversifying, I'm not saying throw the baby out the bathwater, sell everything and move into holdings that have not done well over the last 24 months. But I do think at some stage you see a bit of a profit taking, particularly directed at technology and artificial intelligence, and you see that capital being reallocated into some unloved holdings, some unloved shares that have ultimately been trending or moving sideways over the last 18 months. Now, that outlook gets tricky because we're coming towards the end of the quarter three earnings season in the US. And once again, those technology companies have delivered fantastic earnings, right? What does that mean? Those companies are growing, they're generating revenue, it's making its way down to the bottom line, and they are being rewarded for that in terms of share price appreciation. So it's this kind of double-edged sword where it becomes hard to not allocate to those companies based off how well they're doing. I'm not saying follow the hype here. I'm saying follow the numbers, understand how these companies are actually doing. But I do think that could be a potential opportunity in the future. When that shift happens, when that movement happens, is very challenging to forecast. It's actually impossible. It's a mug's game trying to get the timing exactly right. But I do think it is warranted now to start taking profit on those positions if you have been exposed to them and re-diversify to other sectors. Um, I've got a slide on what those other sectors could look like and some views on regions. I'll happily share them. Let me actually do that because I think
Yeah,
it is
please,
quite
yeah,
an
that'll be
important
great.
one. Because it is quite a topical question. I think it's kind of front and center for a lot of people at the moment. Um, just going to enlarge this. All right, can you guys see that?
Yeah, we got it.
Cool. So some of the sectors that are looking attractive at the moment: industrials, financials, and healthcare. Industrials is an interesting one. It talks to a kind of pick and shovel approach in terms of the AI theme. Industrials would typically be your guys that are providing the electricity, that are doing the actual kind of goods that go into these buildings for these artificial intelligence, these mega centers. So there is a theme starting to emerge in that. Again, it kind of gives you that secondary, third tier exposure to a theme that you want to have exposure to, but it doesn't quite give you that kind of 100% allocation to the actual artificial intelligence company. So I do think that diversifies you a bit, and I do think that comes with a bit more of a defensive profile if you are worried about some kind of pullback centered around artificial intelligence. Financials, another good one. We spoke about interest rates and where they've come from. That starts to look good from a financial point of view. Um, the last one being healthcare. Healthcare has been an interesting one. It's been under significant pressure for the kind of first half of this year. A lot of policy talk around it in the US and pressure from government officials. It's really put a handbrake on healthcare as a sector, but traditionally it has been quite a defensive sector. It's certainly been an unloved sector this year. And as you can see, the sentiment in that is starting to improve, particularly related to government policy in the US. They're starting to adopt it and they're starting to become a lot more less aggressive on it, should I say. Because it's been unloved, because you haven't seen this massive share price appreciation, your valuations are still looking attractive despite the headwinds. They've had positive earnings revisions, so they are still doing well as companies. Resilient cash flows are another important characteristic. Resilient cash flows are always those kind of more quality orientated businesses that tend to defend a lot better. They tend to hold up a lot better should there be any stress or pressure or volatility on the market. Extracting that to a regional view. I think developed markets, as you can see in the top right, and this is where I talk about that balancing act. It's important not to just kind of ditch everything and move into something else. You want to make sure you maintain some exposure, but I think that diversifying out across other developed markets is a good play. We saw it at the beginning of the year. We saw how quickly that shift from US to Europe happened over the first quarter, second quarter of this year. That rally did stall out a bit over the third and now fourth quarter. But I do think that trade gets some fresh legs at some point. The other region that we've slowly turned quite constructive on, emerging markets. They have done well this year. That trade has been on for a while now, but I do think that there's still lots of legs in terms of emerging markets. Um, yeah, China's starting to look a bit more attractive, especially after this recent round of tariff talks between Trump and China. Uh, Garth and I have a joke going on at the moment. It's always quite funny to understand and see how Trump reacts to these kind of meetings. And the press had an interview with him on Air Force One after his meeting with China, and he rated the meeting a 12 out of 10. So just kind of gives you an idea around his mindset and how he felt those meetings went. That was actually quite a risk leading up to that. If that soured, and we saw that kind of tit for tat that we saw earlier in the year with tariffs escalating north of 100%, that has some serious ripple effects into the rest of the world. So good to see that things went positively there, and I think it opens the door for potential emerging market allocations. Another one that's also looking quite attractive in the emerging market basket is India. They've done well. They've kind of done well in the shadows, but they are starting to look attractive again for that potential for the next leg up. If China were to pass the baton in terms of growth to anyone, it would more than likely be India. And again, a nice way to kind of play out that theme, given the size of both India and China. If you are allocating to either exchange traded funds or active managers, completely up to you. You typically do pick up quite a bit of China and India exposure, because in the emerging market basket, they're probably the bigger ones. So yeah, I think that's our kind of view going forward. Obviously, a lot of this is subject to change, depends on the environment. But I do think these are the places that I would start to be looking at.
Scott, I think we answered all 12 questions there.
All of them.
I just want to add to that.
I was trying not to answer too many.
Anthony, can be very technical about these things, but the practicalities of the markets remain, hidden in what Anthony was saying there, and the macroeconomics of it and the natural rebalancing. The plan that one has to have for a portfolio is where you would be looking at a plan today. Okay, what is that plan? What am I trying to achieve? And that's where your natural diversification and your profit taking is going to happen. But just some stats which are interesting is, Anthony uses the term that the tech stocks did the heavy lifting. I think it's so alluded to. He went into a lot of detail about opportunities out there, but the gap between big tech stocks and industrials, utilities, financials has closed significantly from 23, 24 to 25. So you've seen, what a lot of people are missing is, for example, financials in the US hit all-time highs as well, and very few people realized how cheap they were. So I think it's important to recognize what is cheap. And, that's where you're not exiting equity, because we're not believers that there's a crash on the horizon. There's always a crash on the horizon, but there's not an imminent crash on the horizon. And tech stocks could disappoint very easily with their spendings. And when you've got a perfectly priced sector like that, and a sector that's led, 26, 20, 17 year to date, October, September, the tech stocks, what you're seeing is, for example, industrials and financials at 11%, 12%. So that gap between what the tech stocks have been doing from a heavy lifting point of view and those other sectors coming up, and also things, you see a lot of the clever money, for example, and some of the top managers in the world have been picking up small caps at a very, very good price. It's because that gap is closing, and I think you've got to be very aware of that. That we don't believe there's an imminent crash because we had a massive correction. With the tariffs, it was stabilized, but that correction would normally take a lot longer to play out. But because Trump backed off, you had, the S&P 500 is a good indicator, starting at 5,900 points in January, going up, losing 17, nearly 20%, which is proper cash territory. And then the company is actually building solidly on fundamentals. But 493 stocks in the S&P did very little in 23 and 24. And we've been picking those up along the way. And what Anthony said about healthcare, for example, having a rough time this year, these are the opportunities we're looking at. We're looking at very expensive, easy to disappoint stocks, and we're looking to buy and take profit because that 23, 24, 25 return of the AI stocks has been so high. People are starting to find they've got unnatural concentrations, and we always stick to a plan when we invest. And we have, rules like the 753 rules really apply to a portfolio. It's never have more than 5% in a single holding because it can hurt you. Diversification, sector diversification. So I think we'll delve into more of that as we go along. I just wanted to add that in terms of what's actually happening with the macroeconomic side of things. And yeah, I think Anthony gave a lot of detail. Cool.
If I start, I just want to add two things there. The first around language for the guys listening. So correction would be anywhere from -10 to -20. That's considered a market correction, and anything deeper than -20 would be a crash. So I think it's crucial to understand that language. And then secondly, just on the topic of tech and why it is such a double-edged sword, there's two risks, right? So the first risk is that we see this meltdown in technology companies, right? It hasn't been as prominent before as it is now because their capital expenditure, the money that they're taking to invest in all these artificial intelligence projects, was available to them. These tech companies in the past have been absolute cash printing machines. They have had tons and tons and tons of cash on their balance sheet, just waiting for things to reinvest that cash in. Along comes AI, and all of these guys start writing out massive checks. They're not taking on debt to finance these opportunities. They're using their own cash. But at some point, that cash runs out, right? At some point, they no longer have the cash flow to fund all of these projects, and they need to start borrowing in order to fund that. As soon as you start borrowing to fund these opportunities, you essentially have a cost of capital associated with that, right? You have interest rates that you need to think about. And those interest rates, if you're not getting a return on that investment, can start to claw away at your profitability. The consensus is that we're starting to move into that territory where the check sizes are getting bigger and the free cash flow is starting to run out. So these guys need to then borrow to finance these opportunities. That's where the downside risk sits. The upside risk is that they don't falter. These artificial intelligence ventures are as good as they say they are. They generate millions, billions, trillions in revenue, and these companies continue on this rise that they've been on. It's not an unlikely scenario. I mean, think about it. Think about the integration of AI in your everyday life. Think about your use of technology. I mean, think about a world 5 years from now, 10 years from now without technology. I just don't see it. I just don't see it playing out without this adoption of technology and us integrating all of these things to a further extent into our everyday lives. So I think
Can I
that's
interrupt you, Anthony?
Yeah.
Yeah, I think I want to speak also a little bit more directly to James's question that he's asked. And this, whether it's healthy or risky, this cyclical finance between NVIDIA, OpenAI, Microsoft, Oracle. And I think it's very important to put this in a very simple way and understand risk. Ultimately, this circular movement of capital between the companies influences revenue. So one company looks like it's really getting a lot of revenue in, and then the next one sells chips, and you get the circular finance. And this has been a topic of conversation. It is a big risk because what Anthony said there, I mean, I look a lot younger than I actually am, and I actually lived through the tech crash quite at quite a decent age, probably Anthony's age today. And it's not directly linked to, yes, we use tech every day. It's linked to, is there real value in these companies? There's no doubt that AI is going nowhere. But ultimately, when you're pushing money between each other and it's moving around in the company, the ultimate test is where the business, the consumer, picks up the product, because that's where your ultimate revenue play comes from. So whilst they're buying chips and they're doing this, it has to be supported by the market for it to be sustainable. And that's risky territory in these tech stocks. I think Anthony's also right in saying that this stuff's not going anywhere. But it is perfectly priced, and it's got massive revenue numbers. But the story, like internet went nowhere, but there were companies that got very hurt in 2001 in the tech crash, and there were companies that continue to thrive to this day, and people did different things. But there you had exorbitant spending in these companies. It wasn't necessarily related to spending to generate revenue. And on that question, I think it's important to highlight that the momentum in the market Anthony talks about is directly linked to, I don't think the consumer or the adoption of AI is at anywhere close to what it can be. Businesses have not fully integrated. People have not fully integrated it. It's used like the internet by 95% of people as a Google search instrument, whereas its capabilities more so in the rest of the world, but Europe and America's adoption is much higher. I don't think we've even got close to the power of how AI can improve the efficiencies of companies. So I think you're going to see a repricing, and I think these companies are all capable of all-time highs and new highs. But again, I say be very cautious of holding significant percentages in these companies. It can work. Can be your get-rich-quick scheme, and it can happen, but it can also permanently damage you. So I think your portfolio fundamentals and understanding how to build the portfolio and how to treat these gains and this growth with respect within healthy asset management and portfolio management is really the key here. It's why so many self-trading people, 90% in 6 months, lose their money, because they don't have a disciplined plan, they don't have rules around holdings, and then that's where they really get hurt. So James, I hope that does answer your question. It's not outright healthy, and there is risk in it, but in order to feed to the consumer market and to the end user, that money is required between them to deliver the product, and that spend is justified in terms of their potential to supply that market. Hope that helps.
Yeah, perfect. The next question for me, and you kind of touched on it already, Anthony, but I just want to kind of shine a spotlight on it because it's been such a big thing for the last 2 years. Interest rates and inflation. Where do you kind of see them going, and specifically, what does that mean to the stock market, to property, to debt, to global equities, sort of thing. And again, I know you don't have a crystal ball, but I know at the mastermind level you've shared what, as an example, with global equities, what that actually means generally if interest rates are going down. So yeah, what's your kind of take on where interest rates and inflation are going?
Yeah, look, I mean, I'll share a chart with the caveats that, remember, forecasts are forecasts. They're just that, right? These things are incredibly hard to predict. So I would take all forecasts of any nature with a pinch of salt. Top left, you've got inflation, and these are expectations going forward. Middle column, it's what we are expected to end 2025 on. You can see there world inflation at 3.3, United States 2.8, Eurozone 2.1, and so forth. And then in the far right, you can see that kind of 1 year forecasted rate. So coming down slightly on a global level, US pretty much remaining firm at around 2.8, 2.9. Keep in mind the US has an inflation target of 2%. So they are above their inflation target, and the likelihood of them potentially being forced to move that inflation target almost similarly to South Africa last week is still a potential that might actually happen. They might be forced to reconsider that inflation target. You can see the Eurozone inflation well under control there, 2.1, expectation for that to drop even further. That is important when I move to my chart below that on interest rates. And then you can see for the rest of the countries there. I won't bore you guys to death. In terms of interest rate cuts, top right chart looks at the probability of an interest rate cut at the next Federal Reserve meeting, which is in December. For those of you that pay attention, you would have noticed that I shared this chart a few weeks ago, a few days ago in the mastermind session. And those probabilities already have decreased significantly around an interest rate cut in December. Just reaffirming that view from Fed Chair Jerome Powell that he is very data dependent at this stage, and it is not a foregone conclusion that we will see a rate cut in December. For those of you who don't know how to interpret this graph on the top right, the bottom line is where we are currently sitting on US interest rates, hovering between 3.75% and 4%. The likelihood of staying at that current level is 57%. With a 25 basis point cut, the one just above that, 42 odd percent chance of that happening. So what does that mean for the future? It does pare rate expectations back slightly. I don't think it will be as aggressive in the US as we thought a couple of months ago. You can see there the US on the top line. From when I took this screenshot, there was a 25 basis point cut, so that is slightly lower. But the expectation is by February next year, there would have been another cut. So within the next 2-3 months, likely one more cut. And then following that, potential for another cut. And then they kind of stall out at 3.25% in the US. Interestingly, you can see the Eurozone there, that just gets held constant at 2%. The Eurozone is not struggling with an inflation problem. They have done a lot of the heavy lifting, a lot of the interest rate cuts. They were ahead of the Federal Reserve in the US, so they're already quite low, and the likelihood of them going even lower from 2% is quite slim. And then you can see there again the rest of the economies. Note Switzerland also quite far ahead of the curve. They're sitting at 0% interest rates. There has been some murmurings of them potentially going into negative interest rate territory, but I think they will try and avoid that at all costs. That's not a great outcome for them, so they will more than likely stay at zero. But I think that gives you a bit of an idea,
Anthony,
Scott.
could you just talk to the UK there quickly? There's quite a few people here from England, so that maybe just chat to the UK one.
Yeah, UK, as you can see, they've still got struggling with one of the higher levels of inflation, so not wanting to cut rates too quickly. They'll likely cut kind of 2, maybe 3 more times in the next 12 months. But also not trying to do that too aggressively, because they've got other challenges that they're dealing with, in particular inflation.
And then just in terms of the big picture, if interest rates are coming down, which is what we are witnessing here, what does that mean for the stock market and for property and, et cetera? Like what is the trend generally when interest rates are coming down?
Yeah, historically it has been supportive of equity markets. The thinking behind that is, imagine you've got credit card debt, or you're paying a mortgage on your house, and interest rates come down. it ultimately gives you more cash in your pocket, right? And because of that, you are able to spend more of that excess or that free cash flow that you would otherwise be spending on your debt. And typically that is positive for equity markets because that makes its way into some company's pocket, right? And that filters down to that company's bottom line. They become more profitable because they're selling more. There's more growth in the economy, and typically that is a supportive or a good environment for equity markets. There are sectors within equity markets that are more sensitive to interest rate decreases. In particular, small caps. Garth alluded to it just now as an area of opportunity. But as we start to resume this interest rate cut environment, I think it becomes even more supportive for small caps. The reason why is because small caps typically hold a lot more debt than your bigger large cap companies. I spoke just now about Magnificent Seven having tons of free cash flow and they can just go spend that as they please without taking loans. Unfortunately, small caps do not have that problem. They have the opposite problem where they have to take debt in order to finance new ventures. So interest rate cuts help them significantly.
Can I interject there?
Yeah.
Yeah, I think it's important because the equity markets and the listed markets, but when it comes down to property, falling interest rates are critical to property developers and critical to the private property sector. The cost of borrowing capital comes down significantly, and that allows them to start leveraging assets, and it allows them to become cash flow positive. So it's very, very stimulating for property. And property as a sector is actually, it's quite cheap, and it's had a rough time, and it is one of the sectors I think that's going to benefit from the interest rate cuts. Trump wants interest rates to drop faster. He's quite aggressive, even hinting at removing Jerome Powell if he doesn't cut the interest rates faster. But I think it's one of the sectors that does benefit from lower interest rates, and certainly that borrowing rate where they've got, you've got a fully tenanted asset. That asset is paid, your ability to leverage that asset and continue to deliver in property. Property struggles under a very high interest rate environment, so it suits property. The one caveat to the interest rates falling and more money is we don't quite know the effect of tariffs. I mean, what is that going to have on America from an inflationary point of view? I mean, their customs collections and things. I mean, it's astronomical how that has gone up. I mean, it's like 198 billion increase in collections. So that ultimate cost of the cost of produce and tariffs is going to stall. We don't know what that's going to come through as an effect. So that balancing act between inflation and interest rates is a very pivotal one to how we see the markets going forward. And so I think, just understanding, the shutdown and, really having concentration on where they're going to have their spending, I think that needs to sort itself out. So there are risks in those typical fundamentals that drive a market up and down, inflation and interest rates.
They've asked a question there about defensive stocks, and there's a great question here around what he said here is Ray Dalio talks about uncorrelated assets, so that means where they're not tied together. Any thoughts on what these would be and how practical to actually implement these in practice? And the question I actually had here was very similar to that. What are top defensive strategies that high net worth families are using right now to protect capital in volatile markets? It's very much a similar question.
So I'm just gonna talk to that particular Ray Dalio question and his portfolio theory. His all-weather funds, he actually struggled. He has suffered very, very poor performance in his all-weather fund on uncorrelated assets, and this is where understanding the big heavy lifters and the driving force behind it. So Ray Dalio, up until around mid 2025, had produced around 45% cumulative return over 10 years and had really suffered poor performance from uncorrelated assets. this is how strong that performance has been. So when you talk about uncorrelated assets, it's also a balancing act, between different asset classes and different sectors. So there's 11 equity classes, equity sectors. And this is where uncorrelated assets and buying them in concentration becomes a problem, because it leads into the next question that was actually asked there around the 753 rules. Okay. So, and I'll speak to the question around precious metals and gold at the same time. When you look at uncorrelated assets, okay, you want to understand your sectors and how these relate to each other. So, if equity markets are running in general and you're looking at owning something like the S&P 500, within the equity sectors in the S&P 500, you have got massive diversification against and across uncorrelated assets. When you go into something like the NASDAQ, you become a lot more concentrated towards the tech shares and the AI-driven Palantir, all of these companies which are more focused around that sector. So that 753 really talks to, cut your losses on trading at 7%, at 7. Don't hold more than 5%, and of your total net balance sheet, you should never have an assets or a single stock or holding that equals more than 3%. So that's really around what we follow as a principle, and I follow, personally. That doesn't mean I won't have 20% to 25%, even 30%, concentrated in NASDAQ if we saw a healthy correction of these tech stocks in a reprice. So those holdings and those 5% are very important, because I would hold gold, because there's not a definitive answer for any question. Okay, because gold theoretically, and precious metals that have not run as hard as gold, okay, are just another equity class. And they're not necessarily defensive, but having 5% in, because there's a lot of narrative, a lot of research, and I speak to a lot of guys, I think gold can still push 4,800, even up to 5,000. And that I think will remain there. So having 5% in gold, yes, very practical. How to buy these things, also very, very easy. So you've got to put a plan together and understand your diversification. Hold 5% in a gold ETF rather than paying the costs of, sticking gold bullion in your safe and carrying them around. So that all of these uncorrelated assets, all of these sectors can be, depending on how much money you've got, can be very easy to buy to get uncorrelated and diversified, through 3 or 4 ETFs. If you've got a lot of capital, you can get a lot more specific, and you can hold up to 80 shares or 25 concentrated shares of 5% each in a portfolio and really build from there. So yeah, I think that covers a few of the questions and just talks to portfolio principle and allocations. Ant, anything to add there?
I think you've covered it really well. The one thing I would add is the role that private equity and more specifically on a defensive point of view is private debt can play in the equation. I think both of those offer good defensive characteristics. They are consistent in terms of the interest rates that they pay if you are going the private debt route, and often private equity is uncorrelated to financial markets. If you think of a small company, they're typically not reliant on what the big giants are doing on the stock exchange. They kind of trundle along and they do their business. So I think that's another area I would be looking at.
Awesome. So let's look here quickly in terms of what would you say with global liquidity moving? Like, where is the smart money going now? Like, now, the next year, where do you see the smart money going?
Literally all of it's coming to Calio Capital.
Well said, guys.
I'll have my fans that call me an arrogant person, but yeah, no, the smart money. This is very much doing the opposite. And I think Warren Buffett alluded to it, and people people are rebalancing their portfolios. And certainly smart people are keeping cash aside if they've got cash, or holding an ETF rather than cash, so you're not on the bank's balance sheet. So guys that are creating liquidity are mostly are taking it out of very hard run, very well priced tech side, and looking for a correction. But that's not an aggressive sell off. You're looking at some blips in November, and we're probably going to see a blip in January with some profit taking again. But smart money is moving towards the cheaper sectors, the sectors that haven't performed, the small caps, the medicine, the health sector. And that's not to the exclusion. You don't go on a binary bet. I'm out of tech and now I'm going to healthcare. What you start doing is cutting these unnatural percentages that these portfolios have taken in a portfolio. So if you've got a single stock that's run so hard, you did nothing, you bought 5% of it, now it sits at 12%. People are bringing those percentages back down, either holding capital to deploy it back into a cheaper price, and or buying assets or diversifying out of that sector. So, typically you're going to have 60% in portfolio theory, you're going to have 60% in equities. It's a very long conversation what that 60% in equities looks like. But typically, if somebody was running at 85%, 90% in equities right now, people are going back to a bit more of a balanced approach. And certainly the big families that I look after with Anthony and the other guys, we're pulling back down to a neutral position on equity markets. We're not defensive. We're not out of the markets. That we never do. And when I say a neutral position, at the beginning of the year, we were overweight, hovering around 85% in the portfolio, in the growth sectors, and moving into that. Now we're moving to more of a neutral position where we're pulling down quite quickly to sort of the 70, 65, depending on a person's risk personality and their wealth EQ results. We'll pull back between that range of 60 to 75. Okay.
Let's talk about, it's funny, I always find it fascinating how we go through this. So you just mentioned the wealth EQ, and ironically, that was going to be my question, literally into the very next question. So what I was going to say here was, what blind spots do you consistently see in retail and sort of mom and pop type investors, and especially in these cycles now? And it's a double-edged question because, Anthony, I know you speak to the psychology, which I kind of want to talk to as well. And then, Garth, I want to tie this back into why the wealth EQ is so important. Does that make sense? So we want to look at, like, what are the blind spots that the average investors have? And then equally, why is the wealth, maybe, Anthony, we start with you on that question, and then Garth will come to you as to why the wealth EQ becomes so important, because as people get to know themselves better, and as your advisors, as in you guys, understand someone better, you can actually help them far more, And just before you answer, Anthony, I have put up a poll for people. This is one of those help us, help you. So let us know in the poll. You can listen while you fill it in, but I have put the poll up for everyone. Over to you, Anthony.
But just before you carry on, Anthony, I mean, hopefully we don't see this poll, because I'm a very sensitive person. It could hurt my feelings. You know what I mean?
Don't worry, God. I'll keep it private away from
you. Sure, that's a challenging question. I think something that I've seen a lot is this fear of allocation, and you actually spend a lot of your time just sitting in cash because there's that fear and there's that anxiety around investing, or there's that lack of understanding of what to actually invest in. And I think that creates a major blind spot, that creates a major risk, because the likelihood of you underperforming relative to your objectives is high. So I think a lack of allocation is certainly a risk, or a blind spot. And then the second one would probably be this this lack of understanding around the broader investment opportunities. I think that's probably the best way to phrase it. So I think as a lot of you have probably gathered today, not all equity is the same. There's different sectors and there's different asset classes and there's all these different things to consider. And I think it's important to have that understanding around what you actually investing in when you invest in something, right? You invest in the S&P 500, but do you know how much concentration you're picking up in ABC stock, right? I think that deeper understanding, that kind of next level lower, is critical in navigating all of this.
Just before we go to you, Garth, I'd like you just to talk a little bit, Anthony, about the psychology. So we've actually, you actually went into it in quite a lot in the mastermind a couple of months ago. And you just spoke about the psychology of where the average person, gets scared and they get out the market and then they get back in and then they go see their hairdresser and they say, buy Bitcoin, and they buy Bitcoin and then they get scared and they get out. And I'd just love you to talk to the psychology of it. I can actually even find the slides if you want me to show.
Yeah, I think you're going on what we touched on the Wealth Weekend. If you do have the slides, that would be fantastic.
Yeah,
But really,
I've got it for
the
you. I'll bring it up while you're talking.
yeah, it's essentially looks at the opportunity cost of not being invested and the opportunity cost of trying to time the market, right? We are firm believers in not trying to time the market. We believe in time in the market, and there is mountains and mountains of research that points to why you should be in the market. And I think what Scott will share now is what happens when
You
you
should be able
miss.
to see my screen now. Just to show everyone, because you've all got access to this. If you go to the classroom and if you go to the wealth transformation pack and you basically go down to passive income and psychology, which is stage 3, there's a white paper here, psychology of money and investing in uncertain times. You can just click on it and then it's pretty much exactly where Anthony's talking.
If you scroll down a bit, Scott, there's one in particular that I would like to focus on. It's that one. I don't know if it's just my screen, but it is quite small. Is there any way you can zoom in on
Let
that?
me make it a bit bigger. Is that better?
Yeah, thank you. So this just looks at the growth of $10,000 invested into the S&P 500 from 1979, beginning of 1980, up until the end of 2024. If you stayed invested for all of those days, i.e., you did not sell, you did not tinker, you did nothing to it, right? It's Garth's analogy of playing with a bar of soap. That bar of soap inevitably gets smaller. If you did nothing, if you left the soap and you did not wash your hands, you would have $1,708,000, right? If you decided you wanted to tinker with that and you tried to get clever around timing the market, and you ended up missing just 5 days, the best 5 days in that period.
Just to be
That
clear, it's
drop,
5 days in 40 years. Okay, like if you know what I mean? Like,
correct, correct. If you miss those best 5 days, your return drops to just over $1 million. If you missed the 10 best days, that drops down to 762,000. If you missed the best 30 days, that drops to 274. And if you missed the best 50, that drops to 120. The point is there, no one knows when those best days are going to occur. The irony is that those best days are typically followed the day after the worst day. Right. It always happens that way. You get that market kind of sell-off or some kind of volatility event, and then you see markets shooting up a day or two later. So if you miss those, it can get incredibly costly for you over the long term. If you scroll down, Scott, I think there was one more, if I remember correctly. I might be
yeah, so
wrong.
just those percentages, I've written it here just to make it clear for people. And then, yeah, this was, there were two. There was this one, which was the risk of getting in and out of the market, which this was really eye-opening to me.
Yeah, so um, it's the probability of achieving a positive return based on your time in the market, right? So if you spend 1 day in the market, you've got a 53% chance of achieving a positive return, right? Pretty much going to the casino and choosing red or black. If you extend your time period to 1 month, the likelihood or the probability of a positive return increases to 63%, and so on and so forth. If you get all the way up to that 10-year period, you're hovering at 97.4% chance of having a positive return, right? So in other words, the chances of having a negative return over 10 years is 2.6%. So again, it talks to staying invested. It talks to not trying to time the market, but time in the market. And it talks to that long-term investor mindset that one needs to have when they are investing in equity markets. I would go a step further, and it's something that we haven't touched on too much, but I think you will be invested in a specific asset class based off the objective that you need or are trying to achieve, right? So if you can be in equity markets because your time horizon to when you could possibly need that capital, i.e., when you have some kind of event where you start to require income from your portfolio, if you've got a long enough time horizon, then you should be invested in equity markets, because if there is some volatility along the way, you can see out that market cycle and you can ultimately get to the other side without having to become reliant on your capital that could be in a negative as a result of market volatility. So again, it's positioning in the portfolio that is also important.
And I think just to reiterate, you went through that yesterday afternoon, so I'll be putting the recordings up this evening. And if people want to rewatch what Anthony went through, like he literally explained, what do you call them? Silos. You guys have confused me now, but the different silos that so just so we don't need to repeat that completely. Garth, from your side,
Scott, we have changed it again. Hey? We're no longer using silos.
Dude, I'm going to kill you. I keep building documents so people can understand it, and then it's wrong because mine has buckets and even has little pictures of buckets in it.
No, buckets is so 2023.
Yeah, no, it's so 2024. Or it's so March 2025. So Garth, if I turned up and I had $100,000, so just using a round number, what would you look at in terms of a balanced portfolio? You did sort of start talking about the percentages just now with a sort of 60%, etc. But what would just be a rough, and I fully acknowledge, I just want to put a caveat here. It's different for different age types, different stages of life, exactly what Anthony has already alluded to. So that's why bespoke planning is so important. But from your perspective, Garth, what would a sort of a balanced portfolio look like roughly?
Are we talking about that fear of allocation portfolio, or are we talking about someone comes to me today with 100,000 and wants to build a portfolio?
Yeah,
that's the question.
Yeah, I think so. Yeah, I think just broad-based. Yeah.
All right. So the first thing is we moved away from risk profiling a long time ago because you visit your hairdresser, your risk goes up. I've actually got some really good tips from my hairdresser. You must be honest. You said it influences you, but no. So we don't believe in risk profiling. What we believe in is controlling the behavior of the investor, okay, and constructing a significant plan around that investor and their profile. And behavior control is really important. And a person understanding why they react to markets and how they react to markets is critical. So when you build a portfolio, you're going to look at, number one, you've got 3 silos, and that's what comes into it. So let's just for a second park the 3 silos where we would have a growth silo, an income silo, and then the allocation portfolio. I'm just talking to how to put $100,000 into the market. Seriously, you want to have that neutral position today, so 50% in equity. Okay. You've got 50% allocated to the equity markets and diversified equity. We would construct the portfolio to include all of the things that Anthony spoke about in the beginning. And a person should be looking at if they want to keep it extremely simple, you would go for something like the Morgan Stanley Composite Index, known as the MSCI, as your equity allocation. That's going to give you emerging markets. It's going to give you tech stock allocations. And that asset allocation, I actually disagree with the 97.5%. I think over 10 years, you will have 100% positive result on that portfolio, on that 60%. So you should always have equities in that portfolio. However, equities have this habit of really doing strange things, and then they go down and then people don't. And when I say 50% in equities, I mean you buy in. Right now, we would allocate over a period of 3 to 6 months. We would take tranches of 15, maybe 4 tranches, maybe 2 tranches of 25 based on what the market does. But I'm looking to get 50% into that market in a neutral position. And I'm holding 10% in a cash ETF to move to 60%. Okay. The discount comes, I've got that cash. So that's your rainy day. I'm going to purchase a discount. That leaves you with 40% of the portfolio. That's broken up into different sectors. Often, and I'll use the word non-correlated. In other words, we'll use alternatives as the preferred word. And when I say alternatives, I mean private equity, so the direct markets, private credit, the direct markets, and direct property. And also, I would also include in that sector non-correlated or defensive structured products. Okay, it's structured products kind of got a bad name in the early 2000s because a lot of them didn't work because of the double-edged whammy of the tech and the subprime crash in that 10-year period. So a lot of structured products failed. But structured products can give you a very solid equity market return. So we like that as a defensive. So I'll recap. 50% in equities, okay? We can teach you how to break that up into the different classes and the different sectors to have a diversified portfolio. 10% for now, just in cash, being able to pick up and get to that 60. And once you're in that 60, then you're going to just hold that equity for a period of time, and you're not going to touch it. 10 to 20% in private credit or structured products. That's to deliver a consistent 10 to 12% USD return, okay, through a protected nature.
And just so when you say return, Garth, sorry to butt in, but we say return, an income return, just so that people understand.
Yield, yeah.
Cash,
yield. There isn't a capital.
Cash in your pocket.
Yeah. Cash in your pocket. Yeah. Year-on-year cash. And then the private equity sectors where we're able to control risk by having an operator or a professional that we've worked with or a family that has, made hundreds of thousands in a particular sector, and we're able to go into business with them because we manage their preservation. So we're able to generate and create deals that have particular sector certainty. A great example of that was a German property deal, Obi, that we did during COVID, and in 3 years delivered 42% return on capital in euros and a 6% year-on-year yield. Very, very successful investment, and that partner continues to deliver new deals to us. We've been quite cautious with the property sector, but we do believe that the falling interest rates, a new deal that we are going to be putting up there shortly is really ripe and to deliver a return. So that's typical portfolio construction. And which person goes into private equity versus which person goes into the structured products is largely time-based, age-based, and that personality behavioral profile basis. So yeah, that's where it comes out so strongly. We would select those sectors based on what a person's investment personality and financial EQ is.
Let's go there quickly, Garth, because actually I sort of remember I asked a double-edged question and I forgot to go to the wealth EQ. I don't know, Anthony, if you want to talk to that, or Garth, you want to talk to that, because I think it's really, really important. Generally when you go see a financial advisor, they kind of just listen to you. It's exactly what you said, based on a risk approach. You low risk, medium risk, high risk. You're stuck in a bucket. You guys do it completely different from a human-centric perspective. And I'd love you to just explain what that means, because most people will have no idea.
I can talk to it, and I think Anthony will also jump in. So we use and have developed some proprietary IP around a tool called the Enneagram. And it doesn't put a person in a box, but what it does do, it gives you your strongest personality traits and your three dominant styles. What's critical about that is, unlike risk profiling can change very quickly from day to day. You experience Liverpool, having a bad football season, the Barclays Premier League, we're falling from grace. So my risk profile, I'm quite negative at the moment. I'm going to have a different risk profile too when we go and beat Real Madrid. So I'm just saying it's influenced by a lot of things almost immediately and what's happening in your life. Whereas this is very predisposed behavior. So if you look at the 8, for example, and I'll use myself, I'm an assertive investor. I'm confident to take risk. I'm not worried about taking risk. And that's my dominant personality. That doesn't change. There's influences. It moves slightly left and right. So this is my dominant personality. However, I also have the brain side of my profile, which is the analytical investor. So whilst I'm an aggressive risk taker, I also have the 5 brain, where I analyze the daylights out of that risk, so I make an informed, aggressive decision. Okay, and then I also have the 3, which is the performance investor. I like to see the results, but the results are a result of doing the analytical work and being a aggressive risk taker. However, if your dominant personality or your dominant trait, for example, is the cautious investor, that's your strongest number. So the cautious investor, it doesn't matter what I do, you're not going to move out of that zone of cautiousness. Okay. And this is why I say you can shift on days and you're more or less that, but your dominant personality will remain the same. So a cautious investor is almost the antithesis of the assertive investor. So you've got to understand a person, and if you understand a person properly, you can build a portfolio that's driven by that person's style and needs, which has got a third part to it, which is the tool we use to understand those needs, and then this to control the behavior, so we don't end up with a mom and pop, fear, greed reaction to the market. And this is where it gets interesting, is once you've got all 3 of these areas covered, you've got a proper investment plan. And once you've got a proper investment plan, all the fear and the reaction can be controlled. And I think that's what's so critical about doing what we do there. Sorry, guys, I really am fatigued today and feeling a little out of it. So, yeah, I hope that came across and gave a little bit of clarity around what Scott's question was.
I appreciate it. I think Anthony, if I can just, there's 2 things. I know we've covered this. I'm not going to go into this detail, but for you, when someone fills in and you effectively, you get the report, but prior to actually trying to help them build a portfolio, so they're going to get a report, something similar to this, which you get eyes on to then help them effectively do what Gus just said, where there's the 3 legs of the table. So you got the wealth EQ, you got the portfolio construction, you got the life AAM. What difference does it make for you, Anthony, to be able to know the individual and to be able to not only build a portfolio, but I know you said before, it even helps you with communication, because like a 5 person wants 400 pages of detail to read, and an 8 is like, send me a WhatsApp. Like,
Yeah. No, it's critical, Scott. It really is, and it gives us the tools that we need, like you said, to construct these portfolios, and more importantly, communicate in a way that can be received and understood by the client. There's no point if you are frantically typing away emails and explaining things, but the person receiving it doesn't understand it. It doesn't kind of sink in. So it allows us to communicate effectively. And when that communication is effective and the person understands what we're trying to tell them, that leads to a much better relationship because we're all on the same page. There's no kind of gray area. Oh, but I thought you meant this, and it helps align everyone. And I think that is crucial in this kind of financial services relationship.
And just quickly, that final piece of the puzzle, and I'm just going to pull up my screen here quickly, that you shared yesterday. So there's a couple of people online that weren't here yesterday, and so I'm not going to go through this in detail because you went through this in detail. But what Anthony took everyone through is what is an asset income model? How do you actually build a portfolio? And he literally took people through it, and he showed, you meet with Jill or Joe Soap, and they've got kind of their portfolio at the moment, but how do you actually optimize it? And he went through this in detail yesterday. And then again, back to the individual and who they are, then you would get a report on, what should you be doing? What is the core strategy? How old are you? Et cetera, et cetera. And I just think that's so important just to see, but I want to reinforce what you did yesterday, Anthony, which was that the key metric that people need to focus on. There's one number. And can anyone, before I tell you, can anyone remember from yesterday, what is the one number that is the most important number with everything we're discussing right now? Can it just type in the chat box if anyone can remember what that number is? So Shivan said IRR, investment return. Let's see what everyone else says. 99%, 1%, freedom number. That's so interesting. Oh, wow. Okay, so the most important number, you're in the ballpark, is the return assumption. So when you do that modeling, there's a return assumption that you put in. And what Anthony showed people yesterday is literally a 1% change in return assumption has a dramatic impact. I can't remember the exact maths, Anthony. It was like, at a 7% return, you were fine until you were 99. At an 8% return, your family was fine, and you were creating generational wealth. And at a 6% return, you were running out of money by 82. I think if I remember your numbers right. What I'd love you to talk to, Anthony, is that's not a lot. It's not like we're talking 7 and 14%. We're talking 1%. And I think what is so important with what you guys do at a family office is it's one thing to do the modeling, but it's another thing to actually achieve the return. And it's the execution of that return. Because again, anyone can make money on a spreadsheet, but it's actually getting the results. What and why is that so important? So you've done the modeling, and now it's actually about getting those returns. Because again, the significant difference is that most people are doing modeling, but they're not getting the returns, particularly if they're trying to do it themselves. And therefore, they're way off base in terms of where they're going to end up.
Yeah, look, the return, like you say, Scott, is crucial. It gets more crucial, and the results are exacerbated depending on your start age and your end age, right? And that's all down to one thing, and that is compounding. When you start to see it unfold over an extended period of time, the results can be huge. They can be mega. So that 1% is crucial. And again, it's based off other factors. I wouldn't say it's solely on that 1%. There's other ways in which you can massage it. But there is no doubt that return drives capital growth. It drives the kind of key mechanics of the asset income model. Can happily share and people can see what that looks like if everyone was here yesterday.
Do you mind just doing it again, just again quickly if you've got it? We don't need to build the whole model, but I love it where you just went from 7 to 8 and 7 to 6 and what a dramatic impact it has for people.
Yeah, I can literally. So this is actually the example from yesterday. Obviously, we ran through multiple iterations of it and we played around with some of the numbers. But this is, I won't spend too much time on the other assumptions. These other assumptions are important, but based on these current assumptions that we have going here, the return assumption is 6%, right? It's a 6% real return. I won't dive into the mechanics of that. But here you see on the black line, you have capital expiring or capital depleting just after age 85, right? If you change that 6% return to 7%, you essentially get sustainability up until age 99. So you're adding 15 years odd worth of sustainability and capital preservation as a result of a 1% per annum increase in performance. That is the high level.
And just go to 8 quickly, because just show people the impact. What I'm basically trying to say to people is, are you comfortable trying to do this yourself, or do you want professionals that actually specialize in this every day of the week? I mean, look at the difference there. You now get to 99 and assume you pass away, but you're handing over your wealth to future generations.
I just want to chat to that, Scott.
Yeah.
I think what's so critical is also to understand that, 1% can be in the form of just simple analysis work done around being in the right equity sectors can, add 1% to your portfolio a year. And I think this is where blind loyalty is very dangerous. If I go to the doctor today and he says, I'm going to die tomorrow, that's when I'm going to get a second opinion. With money, you don't get a second chance because your most powerful instrument is time and compounding. So asset consulting is critically important. That's to have an unbiased, agnostic report done on your portfolio, which says, yes, you might love fund manager ABC, but fund manager ABC has underperformed the market by 4% year on year, for example. And I can mention somebody like Ray Dalio. You might have loved Ray Dalio, but you didn't notice that there was a massive return gap starting to form. And I think Ray Dalio is a genius, but you didn't notice that there was this gap starting to form in the returns. And this is why it's critical to have an agnostic view, not a portfolio, which is a house portfolio, pushed necessarily on you. You have to have all of the elements actually built around this principle. When we use a fund or anything like that, it's a tax tool. It's got nothing to do with the investment side. The investments remain very consistent inside it. So I think that asset consulting, identifies weak areas in a portfolio. The second thing that's critical, okay, is linking that 1% variation to that time in the market that Anthony showed. Like that's where that 1% very quickly vanishes and becomes 3% when you start timing the market rather than having time in the market. And then also understanding the effect of tax on a portfolio and knowing how to structure a portfolio that you don't lose 2% a year to tax, because now you want to take profit, okay, from a tech-heavy portfolio, you sell it, and off we go, capital gains tax. Thank you very much. So instruments that add 1 to 2%, advisors that are able to show value in saving you 2 to 3% a year in costs, okay, are worth their salt in charging 1% because they're adding that 2%, not their cost. And removing costs in very expensive structures, removing costs in very expensive tax bills is how you get a higher return. The markets will always deliver a set range of returns. Being able to manipulate the factors like structure, tax, and just sector allocation, being in the right asset allocation, can push that 6 to 8% real return without doing a hell of a lot. So I just want to tell you what levers you have to pull there.
No, look, I think that's amazing. And what I'd like to do is pivot to the next question there, which was, what sort of, you and I talk a lot about alternative assets and some of the alternative assets that you've got coming next year, as an example, Garth. What's your kind of take on alternative assets for people to be looking at?
So the alternative assets, there's a 3 question mark, no bonds. So Anthony and I often use instruments in the alternative asset space that replicate or deliver a lower volatility, for example, than bonds to deliver a bond-like return and a bond-like characteristic. So, those alternative assets give a little bit more certainty, because we do live in a time, and I mean, 2022, I think, was a great example where you saw bonds, and equity not actually counter protecting themselves, whereas, we were able to produce a positive return out of structured products and alternative assets. So talking to alternative assets, this is private equity. I've mentioned that before, private property, private credit, and private debt, which give you yields and or a more consistent growth, because you can control the risk through the normal market cycles. And these things are often contrary to the market cycles. So yeah, that's the alternative asset class space. It also includes things like hedge funds, where we can protect on the downside, even make money on the downside. There's kind of where we move into the more sophisticated investor realm. And it's quite hard to understand shorting in that. But there are mechanisms in the alternative market that can deliver returns in spite of the markets being negative. Okay. And that's often when there's higher volatility, you're often seeing really, really good yields and capital growth in the structured product market. And that's giving you a very deep downside protection. So, for the cautious investor that wants to still get equity type returns, but wants a little bit more certainty, we will do bespoke structured products or work with, providers of bespoke structured products.
I think one of the things that's been my big takeaway over the last couple of years, since we've worked together at the mastermind level, is also access to deals that previously you wouldn't have had access to. So that German deal you speak of was pre the mastermind. And I remember trying to get into it, and we had to find, I can't remember, it's like $750,000, but it was like within a week or something. And we didn't get into it. And as you said, I think it did 40% or something. Whereas now, people are being brought to the table and being given an opportunity like we had in Manhattan or whatever. And I think it's really important to get access to these type of operators that most people, 99% of the world, just don't even have access to. They don't even know about it, like in terms of what's happening. So I just think it's really important to reiterate that. I'm nearly done.
Listen, I want to touch on that, Scott. I need to touch on that, because the one thing that I really think people get wrong is when they go online shopping for investments. Okay, because there are huge amounts of deals that are sold online that people can't see what's under the hood. And just talking to that, remember, the deals that we do are generally with operators that are within our collective, within our community, that have traveled a very long road with either partners of ours or with me or with somebody in the business. So we know them. That's the first thing. We know they're not doing their first property deal, and they're not pulling a rabbit out of the hat and hoping like, oh, these are very experienced operators that are not first-time attempts. Venture capital is a very dangerous space if you don't know what you're doing. And, it's got very high returns, but you've got to understand the failure rate and the sort of the 10% rule there, that 3 unicorns are going to come out of, 7 potential disasters. So venture capital and tech is a very different space. And, we have a tech fund with a lot of expertise that takes care of that with us. But, you've got to understand why a deal can work. And I think that's the difference here, is that I don't know if you still use the term wealth hacking, where you're latching onto incredibly strong deals. And any person who runs a business will know there's no such thing as a hassle-free business that just goes from 0 to 100 million without any hiccups. But you've got such a powerful team of managers. You've got such a level of experience that the problems that do come, and the interest rates and inflation and all the wars and things that can influence business, these guys have lived those things and are able to react and to deliver those deals. The only thing that's very important is those deals, they take longer because they deliver a higher return. But, there's so much opportunity also in the secondary market where people have to exit a deal, and we can pick those deals up at such a discount and there's already this captured value. So we've got a lot of that secondary market deals that we do as well. So I think it's just, yeah, it's an interesting space.
Awesome. I've got three more questions, and then I'll look to wrap up. I know you exhausted, Garth. So just Anthony, from your side, what macro indicators do you look at personally to try and track when the market is turning? So, how should everyday investors kind of, what signals should they be looking out for?
Geez, Scott, that is a
We could talk all day about that.
Yeah, that's an incredibly hard question. Look,
I think that question can be answered at the Wealth Weekend, because there we have a full week.
Let me give the
you can see
short
how tired
answer.
I am. I'm dodging that ball.
Yeah, no, fair enough.
Let me give the short answer. I read a lot, and I'm in a fortunate position where I get access to a lot of research from some very good research houses globally. The very short answer is to come to the mastermind on a monthly basis, because it at least gives me an avenue to kind of express that what I've read and what I've seen and what's been of interest, and I think what's worth paying interest to. In terms of that reading and what I'm watching, it's pages and pages of stuff. Yeah, I wouldn't even know where to start to answer that. I hope that gives you.
Just to give some clarity to what you said, if people don't know what you're talking about. One of the things I love is that Anthony turns up for about 20 to 25 minutes a month and just gives us a high-level overview of what do we need to know, what's been going on, and then there's a bit of a Q&A afterwards. So call it half an hour in total. It's not a 400-page report. It's not a 4-hour update. It's short, it's specific, and it's relevant to what's happening, on a monthly basis. And I must admit, for me, it takes all the noise out of the equation. It takes all the anxiety out of the equation, because it's like, right, what do I need to know, in terms of each month? And it's been incredible, Anthony, listening to you for 3 years. I've learned so much about the global economy and how it all fits together. So yeah, I really appreciate what you're saying there. Garth, from your side, in terms of, and I know we actually cover this as an entire session for the best part of 90 minutes to 2 hours, so we're not going to go into this in that level of detail. But, if you look at the global wealth trends, where do you see the big opportunities, now and going forward? And just high level, again, I know we go into this a lot more detail at the last weekend.
Yeah, when we go into that detail, I mean, we've been focused for several years on where these super trends were developing, and we speak extensively to 5 to 7 super trends that are driving the markets, but it's hard to capitalize on that. So a great example is with AI, for example, a lot of people are concentrating on the front end AI deliverer, but we're starting to see that there's a lot of associated opportunity, and we call it the supplying the spades to the gold rush. Okay, the data centers and the other affiliates businesses that benefit from AI. So a lot of the focus is actually on the the value behind that, and the businesses that are coming to the fore and using AI exactly like blockchain, not focusing on the coin, but focusing on businesses that are using blockchain to increase efficiencies. So that's where a lot of the big families are really sort of focusing on. It's no secret that property will always be a significant portion of the high net worth families. So I think you've got to keep a very careful eye on having really, really good property advisors. And we see a lot of opportunity still in property. New York's going to be interesting. I think a lot of the bills and the changes are potentially far-reaching and not actually allowable. So I do think there's still a huge amount of opportunity in the States in property. It's cooled off a lot, but there is particular niche markets in multi-use, small business plus warehousing space that I think still producing great returns and can continue to produce great returns. So I think understanding the affiliate businesses, understanding the other sectors, understanding what will be disrupted, med tech, for example. I mean, I was reading the other day, if you live to 2034, it's likely that every year you live after 2034, you'll be adding a year to your life. That's how fast medical tech is going to advance. And, robotics and areas like that. So I think we've got to talk to more detail like that, more detail around that, because even infrastructure, AI can't exist without massive infrastructure. The power supply to that. A lot of people don't realize the massive rise in Rolls-Royce's share price had actually to do with nuclear power. And this is where you've got to have your finger on the pulse of where the opportunities lie. AI's got a huge electrical demand, okay, a huge power demand. How's that going to be supplied? So you've got to see the whole value chain of this and understand which sectors are there. You've got to understand that we're seeing the wealthiest generation that ever existed, the baby boomers, going into retirement. Okay, so businesses that are able to provide to that silver economy, to that generation that's looking for ways to entertain and spend money. And then, obviously the up and coming generations, how to appeal to the new generations, how to, provide and tap into that. So all of these businesses exist out there. And I can categorically tell you the top 10 businesses on the S&P 500 are not the top 10 that will be there in 20 years' time. It will be the companies that we are identifying now, and those companies that are going to be rising into the new force. So the markets are moving quickly, things are changing quickly, but smart money is looking for that. It's looking for, the unicorns below these big tech companies, and these companies that make a fortune supplying, to this. So that's where our focus lies, and where a lot of the big family focuses lie.
Awesome. So I've got a final question to each of you. It's the same question, but to each of you. And do me a favor, if you haven't filled in the poll, I see that only 23 of you have been well behaved. So the rest of you never know. Anthony and I might have said, "Do you want $1 million?" We'll, dial us here if you haven't looked at the poll. So, but on a serious note, my final question to both of you is, God, most people don't know, and Anthony, same to you, don't know actually the difference between a family office and a financial advisor. They're used to kind of going down the road, meeting the financial advisor, being given a spreadsheet, kind of told to put their money somewhere, and off they go. And they come back a year later and they get a piece of paper. My question is quite a simple one. What is the value of a family office, and why is it different to the typical experience that most people have? And for me personally, I just want to say something before you guys say. It happens month in and month out at the mastermind level, where people come along and go like, "Wow, like I didn't actually realize, I didn't know what I didn't know," like until they've experienced it. But yeah, from your side, what would you say is the difference?
From my side, the single difference between a multi-family office is multiple touch points with one single person coordinating your financial ecosystem. So let me elaborate on that. When you have a financial advisor, he might be an independent financial advisor, and he comes in and he does the job of a financial advisor, but then also often poses as the investment arm. So is he a financial advisor? Is he an asset manager? A family office is vastly different. You have multiple touch points. You might have myself, Anthony, Mark, Gilbert, one of our many financial advisors as the coordinator, but you've got contact points within within Calia. You speak directly to, you've got a private equity manager, you've got a fiduciary structuring expert. So the financial advisor becomes the person who keeps you on the straight and narrow, the psychology, the Enneagram, making sure that let's just talk to that very quickly. Your advisor must suit you as well. We have to have a match in personalities. But the financial advisor is there to introduce the multiple touch points. A family office takes full responsibility for the full ecosystem of wealth, management, preservation, family constitutions, investment. But there's not one single person there posing as an expert on all subjects. And the family office, the multi-family office, also brings this level of global connection that you just don't get with a financial advisor. If you want to speak to somebody in the UK on the new tax laws, we coordinate that. We're able to give you access to that within 24 hours, okay, within our collective. So I think that's the difference. You've got several people, many tools, and a lot of expertise working on your portfolio, whether you're small or massive. And that's what we've tried to do. We've tried to take managing big families and the elements that they have exposure to and systemize that to give everybody access to those multiple touch points and access to that, global financial ecosystem.
Yeah, and I think, Anthony, I'd ask a similar question to you, but I'd give it one contextual slight shift. You and I and have worked very closely together to really take what it was traditionally family office and using tech to democratize it further so that more people have been able to participate, coming through the mastermind, et cetera. And just kind of talk to your experience of what that's meant for people, because they might not have traditionally qualified for the family office per se on their own, but through the mastermind, and because we've been able to digitally make it more accessible, more people have been able to participate. So, and what's been your experience? Because you've helped drive that. I mean, you've been the champion from the Calio side.
Sure, geez, I'm flattered, Scott, but I think it's really been you who's achieved that goal of democratizing and giving accessibility to everyone. I mean, I'm just here to help. So I think that's really been you who's orchestrated that. I think it's helped people a great deal. I think it's given people that accessibility that they otherwise may not have had. And like you say, through the things that you've put together, we've been able to reach these people. We've been able to have these conversations, and ultimately, we've been able to help them. So yeah, I think it's been wonderful. It's been fantastic.
Awesome. Look, guys, I really appreciate your time. I just want to wrap up very quickly. I've got 3 or 4 slides that I just want to share, and then we'll wrap up for the evening. So something that comes up all the time is people say, I feel overwhelmed, and I'm sure even Garth and Anthony, when you guys talk tonight, there's lots of lingo that I'm sure is some of it's traveling over the top of people's heads. And what I always say to people is, it's time to change your framework, because you might be sitting here in your comfort zone, but this is where magic happens, and having these conversations, if you came to a wealth weekend, imagine having this conversation for 2.5 days, it just takes you to a whole nother level of understanding. And, if you want to succeed in this wealth space, you need to be able to speak the language, you need to be able to know your numbers, and you need to be able to have a system. I've shared this video lots of times. It's a very short video, but it's so important on the power of doing it together in a mastermind.
It's extremely predictable.
Scott, do you mind if I say good evening to everybody just before?
No, perfect. Yeah, perfect. No problem, mate. Thanks.
All right, yeah, sorry, I must leave. All right.
No, awesome.
Thank you, everybody.
Appreciate you being here.
Cheers.
Thanks.
Bye-bye.
Let's play that again.
No, this is extremely predictable. Tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case. Wow. I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new. They're not new at all. You've been doing this for thousands of years. When you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
So, basically 5 times quicker, simpler, and safer. That's the research that's out there. And that's why we created the mastermind. So it was actually, as Anthony said, between Anthony and Garth, I've been part of mastermind since 2011. And at the end of the day, we want to help people get results. That's the primary thing. But it's proven that they are more effective. They're even more effective than coaching in terms of getting results. So it was all about getting people. And so what we put together is a joint partnership, which we call Private Wealth Global, which is between the Calio family office team and ourselves. And it's all about getting results safely and simply in terms of that process. And how do we do it? Well, we focused on globally diversified passive income and portfolio growth. We basically diversify across countries, currencies, assets, partners, and time. It's about passive income and portfolio growth. And we follow a systematic approach. So we do annual planning. We then do monthly check-ins. And then you've got your daily activities. And again, I went through this yesterday, so I'm not going to go through it in detail, but there's effectively 9 steps, 3 phases. So the first phase is all about the setup. and you sit with me, you sit with, getting your Enneagram and wealth, your EQ, then you do the planning with the family office. So, what Garth was talking about is the health check. Like, what is your current portfolio? What is your tax? What is your structuring? What are your assets, etc. Anthony also spoke about overlap, and often people have, fees on top of fees and everything else. And then it's about optimizing your portfolio. And so this becomes really important. It's the whole planning phase. And then it's the execution. It's actually the mindset, the execution. It's the ongoing knowledge transfer that Anthony was talking about on a monthly basis. So if you are interested, there's two ways. You can literally go to the link, Diversification Mastermind. There's two ways to participate. So there's only 3 or 4 weeks left in the year. So the one is, if you go to it, you'll see that there's a button called priority, and that's where you'll get priority. So that what I've agreed with Anthony is that 5 people will be able to sit with me and with Anthony before Christmas, so that people can actually hit the ground running and make sure that next year they've got the peace of mind, they hit the ground running. So by the way, Anthony, 4 of those slots were taken today. So there's literally 1 slot left. So if someone is interested after tonight, I'd recommend you go to the priority. And the second option is apply. And that's where, so if you do priority, you'll literally meet with me tomorrow. There's a couple of slots. I fly to London on Wednesday. So it's literally tomorrow. It's a half-an-hour meeting. I just want to understand where you're at and make sure that there's an alignment and a fit. And if you hit the apply, then basically you'll go in a process with Alex, and he can talk you through. If you're not 100% sure yet, he can talk you through the process. And but the priority people will be the ones that get the first access in terms of that process. And so, yeah, I've been through this. I've went through it all weekend with you. Most people have this excuse of, I don't have the money, I don't have the knowledge, or I don't have the time. And that's where they get to the end of the year with frustration and anxiety, and blaming other people. But, my invitation to you is get in the top 1%, get what you want, get the knowledge, get the time you want. And, it's about creating the generational wealth. This is all about excuses. This is all about results. And hopefully tonight, if nothing else, Anthony and Garth have shared with you how they're doing it at the family office level and how you can get results. And I love the saying, if you want to go fast, go alone. If you want to go far, go together. And so that's it. I did, by the way, Anthony, you'll quite enjoy this actually as an analogy. So if you're driving from Joburg to Cape Town or London to Edinburgh, if you walk, then it takes 13 days, whereas in London to Edinburgh is 6 days. And that's what most people in their wealth space are actually doing. They're trying to do it on their own. They're going on courses or whatever it is. If you jump in a car, it takes you 17 hours and 7 hours if you're going London to Edinburgh. And if you jump on an airplane, then it's 2 hours. It's a lot quicker to be able to do it. And it's an hour 15. And the analogy that I gave everyone, Anthony, is that, trying to do it on your own is like trying to walk. If you join one of our digital communities like the Wealth Hackers and the Wealth Accelerator, that's like jumping in a car. It's more efficient, but it's still slower. And when you join the family office and the mastermind, that's like jumping on an airplane. So for those of you who are keen to join, let us know. Someone was also asking about the recordings, and I just wanted to share with you, if you go to the Wealth Hacker classroom here, which you've all got access to, there's the Know Your Numbers. And if you go into it, all of the modules will basically have the recordings and everything. I need to put up the ones from Sunday, and the recording from this will also be there. And then also, if you want the Wealth Transformation Pack, it's there. So you should all have access to all of that in terms of that process already. If you don't, reach out to us in terms of it. And as always, I love to finish off with a bit of a game. What did you think of this workshop or this session? So 3, 2, 1, 1 or 2 words. What did you think? 3, 2, 1. Type it in the chat box for us. I'm always fascinated to see what people thought in terms of everything. So yeah, just type in the chat box. I'd really appreciate it. Thanks for all the chats. And Anthony, as always, I really appreciate you coming and sharing. You literally are showing people how to jump in an airplane and how to do it far more effectively. And so for those that want to and would love to kind of have Anthony hold their hand when it comes to their planning and their finances and their wealth, and obviously Garth as well, then go along to this link, Diversification Mastermind. I will let me just open it up. I'll show you how this works quickly. Any final comments, Anthony, or anything else from anyone else? I do know that I've gone over my time because we said 90 minutes, but anything else from anyone else. So you can see here is the landing page, the link. You've got the video from me. You've got priority and apply. And if you want to, you can go. There's a whole Q&A, and then there's a bunch of sort of testimonials and stuff here. You can go and see success stories in terms of that process. But yeah, any kind of closing thoughts from your side, Anthony?
No, all good. I think it was a really, really good session. I think we covered a lot. We dived into many different subjects, and yeah, I hope everyone got value out of it and they enjoyed it.
Awesome. So I'm just putting in the link. Someone was asking for the link, so I'll put the link in the chat for everyone. Yeah, look, Anthony, from my side, I really, really appreciate it. I sometimes think people, and hopefully tonight by listening and learning, most people don't know what they don't know, and what's so valuable in this wealth space is actually hanging around and having these conversations. And if tonight felt a bit overwhelming, went over your head, that's fine. It would. If you went to, the first economics lecture and you'd never heard anything about economics, it would. But being part of these conversations makes a massive difference. So thank you, Anthony, for being here, and obviously Garth as well, and to all of you. I really appreciate it. And hopefully now this is another thing to help you finish 2025 strong and start 2026 free by now knowing how you can get a plan. You can have someone like Anthony help you build your plan for you and your family. Where you can find the partners. God spoke a lot about partners and how you can find the right partners. And most importantly, as you go into Christmas or the festive season, whatever you call it, having the peace of mind to know that next year will be different in terms of that whole process. And that's what we mean by finishing the year strong and starting the year free. So thanks to everyone. I really appreciate all your time. Anthony, as always, it's been amazing. If you haven't filled in the poll, the little bogeyman's going to come and haunt you tonight because you didn't fill in the poll. No, but on a serious note, we always appreciate the feedback. It's just useful to know what's working for people, what's not. But yeah, thank you for everyone's time. I deeply appreciate it, and we'll see you soon. And if you want more of this, either come to the mastermind or come to the Wealth Weekend, because what we just did for 90 minutes is what we do for 2.5 days at the Wealth Weekend. So thank you, everyone. Appreciate it.
Cool. Cheers, guys. Thank you, Scott.
Night,
Have a good
everyone.
evening. Bye.